price on your screen is lying to you. Right now, as you watch this video, silver is being quoted at $85 per ounce on every financial website, every app, every news ticker across America. But walk into any coin shop in New York, Chicago, or Dallas today and try to buy a single silver eagle. They will look you in the eye and tell you something that will change how you see money forever. Nobody has silver, and what little is left will cost you a lot more than $85. That gap, the gap between the number on your phone and the price tag on the coin in front of you, is not a glitch. It is not a temporary supply chain hiccup. It is the most important signal in the entire financial system right now. It is telling you that the COMEX, the exchange that has set the price of silver for decades, is broken. Not struggling, not under pressure, broken. And what happens next will shock the majority of Americans who have never thought twice about this market. Let us start from the very beginning, because most people have no idea how the silver price is actually determined. They assume it works the same way as buying a car or a house. Supply meets demand, and a price is reached. But that is not how it works. The silver price that you see on your screen is not determined by people physically buying and selling silver bars. It is determined by people buying and selling paper contracts, pieces of paper that represent silver, that, in most cases, will never be delivered. These contracts trade on the commodity exchange in New York, and they dwarf the actual physical silver market by a staggering factor. For every single ounce of real, physical silver that exists in verified exchange warehouses, analysts estimate there are somewhere between 300 and 500 paper ounces trading hands. Think about that. The price of your physical silver is being set by a market where the overwhelming majority of participants will never touch or hold an actual ounce of metal. This system worked for a long time because nobody actually demanded delivery. Traders would simply roll their contracts forward or settle in cash. But that separation between paper and physical is collapsing right now, and the data is screaming it at anyone willing to look. The registered silver inventories at the exchange, that is the silver actually available and ready for delivery if someone demands it, have fallen to levels that make seasoned commodity traders go pale. We are sitting at inventory levels not seen in over a decade. Hundreds of millions of ounces have quietly left those warehouses over the past 2 years, and the pace is accelerating. When inventory falls like this, it means one of two things. Either industrial users and smart money investors are pulling their physical metal out because they no longer trust the system, or they are pulling it out because demand from somewhere else is so intense that the metal is being sucked away faster than it can be replaced. In this case, both are happening simultaneously. And the moment registered inventory hits zero, the paper market does not just crack, it shatters. Because at that point, there is no metal left to back up even a fraction of the open contracts. Now here is where the story gets truly dangerous for the dollar-denominated financial system. Because the crisis at the COMEX is not happening in isolation. It is happening as a direct consequence of what is going on 12 time zones away, in Shanghai. The Shanghai Gold Exchange and its silver contract has been quietly repricing this metal for months. While New York was quoting silver at $85, Shanghai was pricing physical silver at the equivalent of $93. That is an $8 spread between two major global exchanges for the exact same metal. In normal times, an arbitrage gap like that lasts for minutes, maybe hours, before traders close it by moving metal from the cheaper market to the more expensive one. But this gap has been widening, not closing. And the reason it is widening tells you everything you need to know about the future of this market. The reason is that the metal is already moving. It is moving in one direction, from west to east, as fast as cargo planes can carry it. Every vault in London, every warehouse registered with the COMEX in New York, is being systematically drained. Major banks and trading firms are doing exactly what any rational actor would do when presented with an $8 risk-free profit on every ounce. They buy silver in New York at $85. They ship it to Shanghai. They sell it for $93. They pocket the difference. Multiply that times millions of ounces, and you have one of the most powerful and relentless one-way flows of physical metal in modern history. So the West is hemorrhaging its silver reserves to feed a price signal coming out of China, and the COMEX is powerless to stop it, because the COMEX only controls paper, and paper cannot replace what is being loaded onto those planes. But why is Shanghai willing to pay so much more? Why is China so desperate for physical silver that it is pricing it $8 above the New York paper market? The answer is not speculation. It is not some hedge fund making a bet. The answer is industry, and it is panic at the industrial level. China is the manufacturing center of the global solar energy revolution. A single solar panel contains between 15 and 20 grams of silver. Not a substitute. Actual silver, because no other element conducts electricity at the efficiency level required for a photovoltaic cell. China installed more solar capacity in the past 2 years than the entire rest of the world combined. And now add to that the electric vehicle revolution. Every electric vehicle built contains silver in its circuit boards, its battery management systems, and its charging contacts. Add artificial intelligence data centers, which require massive amounts of silver in their server connections. Add military electronics. Add 5G infrastructure. The industrial demand for silver is not a future projection. It is a present emergency, and it is growing faster than any mine on Earth can respond. This is the critical thing most retail investors completely miss when they look at silver. They treat it purely as a monetary metal, as a hedge against inflation, as a poor man's gold. And while it is all of those things, it is also an industrial commodity with no substitute in dozens of cutting-edge applications. And here is the terrifying implication. A speculator will sell when the price goes up, but a solar panel manufacturer in Shenzhen does not sell when silver gets more expensive. A manufacturer buys more, faster, because the alternative, not having silver, means the factory goes dark. Industrial buyers are what economists call price inelastic. They will pay whatever they have to pay to keep the production line moving. And right now, those industrial buyers are hoarding. They are not ordering 30 days of supply. They are ordering 12 to 24 months of supply because they watched what happened during the chip shortage and swore they would never be caught without strategic inventory again. This is the just-in-case economy replacing the just-in-time economy, and silver is at the epicenter of it. Now let us zoom out and look at silver from the only measuring stick that actually matters. Not the dollar, not any fiat currency a government can print into oblivion, but gold. The gold-to-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, With gold trading above $4,600 and silver at $85, that ratio sits at approximately 54 to 1. Here is why that number is so revealing. Geologically, for every ounce of gold in the Earth's crust, there are approximately 15 ounces of silver. 15 to 1 is what nature produced. And for most of recorded financial history, from the Roman Empire through the founding of the United States itself, the price ratio reflected that geological reality at roughly 15 ounces of silver per ounce of gold. But what happened in the 20th century is extraordinary. The paper derivatives market allowed financial institutions to suppress the silver price by flooding it with unbacked contracts. The ratio exploded to 80 to 1, 90 to 1, and during the pandemic panic of March 2020, it briefly hit 120 to 1. Today, at 54 to 1, we have seen significant mean reversion, but we are still far from the historical norm. If gold holds above $4,600 and the ratio returns to just 30 to 1, still twice the geological ratio, silver needs to be above $150 per ounce. If it returns to the historical 15 to 1, the math requires silver above $300. The people who look at $85 and think they have missed the move are making the most expensive analytical error of their financial lives. Let us now talk about what is actually happening at street level in America, because this is where the reality of the breakdown becomes impossible to ignore. Walk into a reputable coin dealer in any major American city and ask to buy silver. What you will find is that the price on the receipt looks nothing like the price on your screen. The spot price might say $85, but the actual price you will pay for a 1-ounce American Silver Eagle, the official silver coin of the United States government, is somewhere between $93 and $95. That premium has exploded. In normal market conditions, premiums on Silver Eagles run about $3 to $4 above spot. That is the mint's production cost plus the dealer's margin. Fair and predictable. But $9 to $10 above spot? That is the physical market sending an emergency signal. That premium is the market's way of saying that the $85 paper price is fiction, that the real cost of acquiring an ounce of silver that you can hold in your hand is fundamentally different from the number the exchange is printing. And this matters for one simple reason. The paper price is the one that gets reported on the news, say the one that most investors use to make decisions. But the physical premium is the one that tells you what is actually happening in the real world. And the real world is screaming that silver is far more expensive and far more scarce than the official price suggests. The delivery delays compound everything. Major dealers across the country are now quoting lead times of 6 to 8 weeks for new silver orders. If you place an order with a major online dealer today, they will tell you they hope to ship your silver by late spring. That is not a logistics problem. That is a dealer selling you metal they do not have yet, based on orders they have placed with mints who cannot get enough silver blanks from refiners, who cannot get enough raw silver from mines that are already running at full capacity. The supply chain is maxed out from end to end, and when the entire pipeline is full and the price still cannot satisfy demand, there is only one valve left. The price must rise, high enough to ration the available supply to whoever values it most. That is not economics theory. That is the iron law of scarcity. Here is the most important question you should be asking yourself. Right now, what do you actually do with this information? Because knowing that silver is undervalued relative to gold, knowing that the inventories are draining, knowing that China is hoarding, none of that helps you if you do not have a plan. The most common mistake people make when they finally understand a market like this is they panic buy at the first available moment, pay enormous premiums, and then panic sell the second the price dips. The strategy that actually works, the strategy that the serious money uses, is far more patient. First, you do not buy silver to get rich in paper terms. You buy silver to preserve purchasing power. Your goal is not to convert your silver back into dollars at a higher price. Your goal is to protect your wealth against the slow destruction of dollar purchasing power that has been ongoing since 1971, when the government severed the dollar's link to gold. Every year that Washington runs a deficit, and it has run one every single year for decades, it is quietly diluting every dollar you own. Silver is the antidote to that dilution. Second, when silver is on the front page of every financial publication, when every casual investor wants some, that is the time to think about what you want to own with your silver. The classic move is what serious investors call ounces to acres, converting physical silver at the peak of a mania into real estate, into productive farmland, into hard assets that generate ongoing value. Because the goal was never to end up holding paper. The goal was to get from one hard asset to another without the paper currency eating your wealth in transit. And if you are waiting for a pullback before buying, understand what you are actually waiting for. The banks that run the paper market have enormous incentive to shake out weak hands. They will hammer the paper price. They will create fear-inducing red candles on the chart. And every time they do, the physical buyers, the industrial users, the sovereign wealth funds, the people who actually understand what is happening, step in and buy physical metal at the artificially suppressed price. They are grateful for the dip. The question is which side of that trade you want to be on, because the window is shrinking. Every week that inventories fall, every week that Shanghai bids above New York, every week that mine output fails to meet industrial demand, the window closes a little more. And when it finally closes, when the last registered ounce leaves the last warehouse and the exchange is forced to settle contracts in cash rather than metal, the paper price becomes completely irrelevant. The only price that matters is the price you can actually buy physical silver for. And if the current trajectory continues, that price will look nothing like what you see on your screen today. The exchange was not built to withstand a world in which physical demand, industrial, sovereign, and retail all converging at once exceeds the entire registered inventory. It was built for a world where paper was sufficient, where the promise of delivery was good enough, where the financial system's credibility was beyond question. That world no longer exists. The $85 number is the last gasp of a pricing mechanism that is fundamentally disconnected from physical reality. And physical reality always wins. This is not the end of the story. It is the moment right before everything changes. The COMEX has survived crises before by printing more paper, but you cannot print a silver bar. You cannot short a solar panel into existence. The geological limit is real. The industrial demand is real. And the $8 gap between New York and Shanghai is the clearest signal the market has ever sent. History does not repeat, but it rhymes. And right now, it is rhyming very loudly with 1980. Except this time, the industrial floor under silver means there is no ceiling in sight. If this video opened your eyes to what is actually happening in the silver market, hit the like button right now. It takes 1 second, and it tells the algorithm that this information needs to reach more people. Subscribe and turn on notifications so you do not miss what comes next, because we are just getting started. The next video will reveal exactly which mining companies and silver-backed instruments are positioned to capture the maximum upside from everything we discussed today. But you have done the hard part. You stayed to the end, and now you understand what 99% of Americans do not. Do not let that edge go to waste. Subscribe. Stay informed. See you in the next one.